And that means we are now live here on our YouTube channel. It is Tackle Trading's special event here on a Monday evening, 11/22/2021. Swing Trading 101, the basics of swing trading, presented by Tackle Trading. I am your host, Coach Tim Justice, and your educator, your teacher tonight. Coach Matt Justice is going to be coming on in here in just 1 minute. In fact, Tackle Trading is our sponsor here, and we're on the YouTube channel here for Tackle Trading. There's a couple things that I want you guys to be aware of that we're doing over there in the community that you should be a part of, and definitely want to invite you to come and do that. We got a couple of weekly podcasts that are fantastic, the Trading Justice podcast and the Huddle, both of which you can find on any of your favorite podcast apps. If you're a pro member, every weekend we have wonderful newsletter that will give you updates on the markets each and every week, as well as pick list from the bull and the bear perspective for stock and option traders, as well as commodity analysis in our commodity report as well. We have daily shows, including every day at 11 o'clock Eastern. We have our Traders Lounge where you can get questions answered from a coach, nightly programming, including our coaches show, our cash flow clubs, and yes, every day here on YouTube, we do our halftime report as well. We have courses. If you're the type of student who wants to put your butt in the seat and learn, definitely a wonderful place to go is tackletrading.com and start with that 7-step guide to trading and then work your way through the 101 series if you would. Our premium blogs are fantastic. I love them each and every day. The Tackle Today will get you updated on the markets, mindset to start the day delivered right to your email, as well as premium blogs. And then if you're an analytical and you love tools like I do, we have wonderful journals, a playbook with all of the rules designed for option traders on Delta and Theta. And yes, we're on all of the major social media networks as well. Facebook, Instagram, you name it. Go find Tackle Trading and like and subscribe. Your educator here today at Tackle Trading and for tonight's event is going to be my brother, the co-founder and CEO of our company here at Tackle Trading, Coach Matt Justice. Matt is a natural leader. He's an entrepreneur. There's no question about it. He's a trader and investor since I've known him 17 years ago, since we both started in the market. And he's the designer of systems, including the STEP system course, which is one of our premium courses at Tackle Trading. He's the co-host of our podcast, which we've done 450 episodes of that you're going to love. But most importantly, guys, he's a natural mentor and a natural coach. Somebody's going to teach you, somebody's going to help you in the field of trading and get some direction that you need. Matt, how are you doing this evening, sir?
Tim, I'm doing absolutely fantastic. I'm excited to be here to present the art of swing trading. It's a topic very near and dear to my heart. It's certainly one of my favorite styles of trading as a swing trader, and I'm looking forward to teaching all traders, new traders, veteran traders alike, how I approach the art of technical analysis and understanding trends and patterns and support and resistance and those major concepts from a technical perspective that goes into a style of trading such as swing trading. And Tim, tonight I'm going to be doing a little. I always like to have a little bit of a theme to kind of how I present and the story I'm trying to tell from a technical perspective. And Jesse Livermore is just you ask any trader out there who's the greatest investor, and almost everybody will just say Warren Buffett, and I'm not going to argue with them at all on that one. Good old Uncle Warren Buffett is truly one of the greatest out there. But if you ask traders who the greatest trader is of all time, Jesse Livermore certainly comes to mind to a lot of traders. And there's an amazing book that I want you to pick up. We'll talk about here in just at the end of the presentation here tonight. But Jesse Livermore was a trader in the early 20th century, and he learned how to trade there by, going to the shops there in New York City and learning how to trade. And he was a young man. We're talking 14, 15, 16, 17 years old, all the way back in the early 20th century. And, he made a comment, and we're going to have a few quotes from Jesse Livermore here tonight as I walk through this art of swing trading. And he said, there's nothing new in Wall Street. There can't be because speculation is old as the hills. Whatever happens in the stock market today has happened before, and it will happen again. And that quote means so much to me as a trader, because swing trading and trading in general, whether you're talking about long-term investors with market cycles and the consistent nature of the market cycle that's tied to, say, big macro policies like fiscal and monetary policy, or whether you're looking at an intraday chart and you're looking at day trading, there's patterns that repeat over and over and over again. And technology may change. Obviously, in the 21st century, with all this advancement of technology, we're like, oh man, the market is so much more efficient today than it's ever been. I don't think so, because again, at the end of the day, think about what Jesse Livermore said. Technology may change, things may evolve, but at the end of the day, we are our natural state. Human nature is what human nature is. And it is because of that belief that patterns have a tendency to repeat, markets have a tendency to repeat themselves as well. And so when it comes to the art of what is swing trading in general is simply short-term trading. It's highly technical. We'll get into some of the concepts that go into this, into swing trading here in just a moment. But when you're talking about swing trading, it's simply highly technical, short-term, where we're trying to take advantage of certain historical movements in a stock. And so when you look at the definition, and I'm going to read this definition for you, when you look at the definition of swing trading, it basically says it refers to a speculative short-term type of trading that attempts to capture gains in a financial instrument such as stock, options, futures, forex within a time frame. You can throw crypto in there as well, within a time frame that can range from at least 1 to 2 days to up to 2 weeks. That time frame definition, I will say, is subjective. Some of the best arguments, debates, and discussions I have had with amazing, awesome technicians out there have been towards how long is a swing trade? Is it 2 days? Is it 2 weeks? I always like to say that the stock itself, it determines the time frame for that, because what you're trying to do as a swing trader, and I'll get into this here in just 1 second, is you're trying to capture movements between what is called pivot points. And whether that's 2 days, 10 days, 5 days, it really doesn't matter to me. And so when you're looking at swing traders, you really got to categorize the 4 different types of traders. And so there's 4 different types of traders, all associated to different time frames. You have day traders, swing traders, position traders, and then you have the investor class. When it comes to day traders, they're just trying to get in and out of the same instrument in the same day. They're very heavy in crypto, they're very heavy in forex, and they're very heavy in the commodity market as well. But day trading in the stock and the options market is a popular way to go about trading as well. Once again, focusing on intraday time frames, you're really looking at short-term trading, minutes to hours type scenarios. The swing trader lives on daily charts. And once again, the time frame debate aside, what you're really trying to understand in the art of a swing trade is you're looking at trends, patterns, you're looking at support and resistance. And as you look at those 3 big picture items, again, trend analysis, pattern recognition, and the concept of support and resistance, those 3 concepts put together tell the story of the trend, tell the personality of the stock. And so what the swing trader tries to do is they simply try to take advantage of movements between pivot points. And so the swing trader looks to buy its support, capture the movement between the support pivot and the resistance pivot. And so you're getting in, you're getting out, you're getting in, you're getting out. You try to take advantage of the momentum of a stock. You try to take advantage of the areas between these 2 pivot points. And so the understanding of support and resistance is chiefly most important when it comes to the art of the swing trader. The position trader, on the other hand, basically says to the swing trader, you know what, guys? You go nickel and dime that trend all you want. You go out there and you get in and out as much as you want. The trend trader, i.e. the position trader, think about old Richard Dennis, the old turtle traders, guys. When the old turtle traders basically would get into a position, they would maintain that position until the trend changed, not the pattern within a trend. See, that's what a swing trader does. They're looking at the overall trend to know the direction they want to trade, but they're really relying on their pattern recognition within a trend to identify where they're getting in and where they're getting out within that trend. Whereas the position trader basically says, I have a trend, and as long as support continually increases, I have nothing to worry about. They want to capture the entirety of the trend, and so they're not looking to nickel and dime. The swing trader to the position trader, there's not a lot of gap distance in the differences between a swing trader and a position trader. They're both they're both highly technical in their trading. They're highly technical in when they're getting in and when they're getting out. The difference is the swing trader tries to micromanage the position within a trend. A position trader simply tries to take advantage of a trend and then manage the trade over time as support starts building. And so the position trader looks at that pivot here and they say, okay, that's fantastic. We got an increase in support. Let's adjust our stop loss. The swing trader looks at that and they say, ooh, new entry, right? And so one's just getting in and out within the trend. The other one's trying to capture the entirety of the trend. And then when it comes to the investor class, investors look to hold long term. Long term can be defined in many ways, many ways. Whether you're getting married to this stock and you are literally an investor for the end of time, or you're trying to take advantage of market cycles, you're trying to take advantage of dividend, cash flow, whatever the case might be, you are investing in that company. You're looking at it from a long-term perspective. I do think it is important to also understand the differences in the types of analysis when it comes to the investor class versus when it comes to the swing traders and traders in general. Whereas investors will focus big picture, guys, big picture things, fundamental analysis. What is the PE ratio? What is the PEG ratio? What's their debt to equity ratio? What's their balance sheet look like? How does this fit within a portfolio? How do I want to cash flow? They look at big picture items, whereas the trader, they don't care about PE ratios. I can't tell you the last time I was having a conversation with the trader and they said, oh, but have you seen the value? Aren't you really concerned about value? Yes, I am. I absolutely. How can you not be concerned about value? Because value as of right now is probably the second most overvalued market that we've ever had in relationship to the dot-com market, which was probably slightly higher value. Yes, I have concerns about value. Tim has concerns about value. Most investors at this point in a market cycle have some concerns about value. But the trader, they don't care about that. The trader's not going to ask what the PE ratio is on a support bounce in a bullish uptrend with momentum. They're just going to say, where am I going to trigger and where am I going to put a stop loss? And so it simplifies the analysis to a certain extent, but it doesn't make it easier. It's just different. Whereas the investor's looking at behavioral analysis, traders are looking at probability analysis and trying to find their edge. Certainly investors look at technical analysis, but they look at the big picture items, weekly charts, monthly charts, relationship to the S&P 500. Whereas the traders, they're looking for trends, they're looking for patterns, they're focusing on candlesticks. And then obviously you're talking big picture, monetary, fiscal, but most importantly, in all those forms of analysis, the investor is looking for how much money can I cash flow? What is the dividend? Can I write covered calls against the position and compound those gains long term? Whereas the trader doesn't care about cash flow. The trader doesn't care about dividend. The trader cares about delta. They care about the direction that it's going, and thus that's why we highly regard technical analysis. Now, when it comes to technical analysis, ladies and gentlemen, we at Tackle Trading, we believe in the three pillars of technical analysis. And I want you guys to write this down, okay? I want you to write this down. First and foremost, price is king, okay? Nothing else matters. Price is king. I don't care about your opinion. The market doesn't care about my opinion. It doesn't care about Coach Tim's opinion. I love Coach Emily's opinion. I love it. She has such beautiful analysis. I love listening to her. I love debating with Coach Emily regarding, value or fundamentals or whatever the case might be. But you know what we never debate? Price. Because price is king, price is queen, price is everything because it moves in cycles and trends. Remember what Jesse Livermore said. There's nothing new, guys. It repeats. It repeats. And so we believe that price as a technician does move in a cycle, does move in patterns, does move in trends that we can take advantage of because history being the best barometer for the future, history does in fact have a tendency to repeat themselves. Now, for the most part tonight, and for the most part, when you get into the step system and you start learning the art of swing trading as taught through the step system, is you're going to really focus on three big picture items when it comes to technical analysis. The first is what we call trend analysis. We want to identify the trend. Okay, just the direction of the market. What direction is the market going? Is the market bullish? We want to be bullish. We want to position as a bullish trader. Is the market bearish? We don't care. We want to be bearish. We want to position to where the market is going. Is the market neutral? We want to first identify what the trend of the instrument, whether you're trading the S&P 500, whether you're trading Bitcoin, whether you're trading advanced micro devices, it really doesn't matter. We want to identify the direction of the market first. That tells us the direction we want to trade. We are not contrarian traders, guys. That is not who we are at Tackle Trading. We follow the market because here's the simple reality, guys. Our money doesn't move the market. Our money does not move the market. Collectively, the market moves based on that. But one individual, if they're not named Elon Musk, Warren Buffett, Peter Lynch, the greats out there, right? Kathy Wood. If they talk, the market will listen sometimes. If they move, the market will move. That's not traders for the most part. We're sitting there and we're identifying the market so that we can move in conjunction with the market. The second thing we want to do is we want to identify the pattern. What is the specific pattern? There are many patterns in the market, and we'll talk about those patterns here in just a moment. You have continuation patterns, you have reversal patterns, you have momentum based, you have slowing momentum based. There's a lot of different patterns, but the beautiful thing about pattern recognition, guys, is it's all visual up here. It's all visual. You can teach a child how to do pattern recognition. We'll talk about that here in one moment. But it is the pattern that defines the probability. Remember what traders care about. Investors, fundamental analysis, behavioral analysis, technical analysis, fiscal analysis, economic analysis, monetary analysis. What do traders care about? Where's my edge? Where's my edge? Where's my 51% edge? Where's my 53% edge? Where's my 90% edge if we're talking about cash flow systems? We're looking for that probability. We're defining that probability based on the pattern. And then the third thing we want to do is we want to identify where support and resistance is. And I'm going to introduce you later on tonight to my good friend, yes, old veteran members of Tackle Trading, know my good friend Marty the Elephant. I'm going to introduce you guys to Marty the Elephant because he loves to jump on support. We'll talk about that here in a second. But the concepts of support and resistance are so vitally important because it's where we make our decisions. We buy at support and we sell at resistance, period, end of sentence. There's no debate. Now, let's tackle trade. Let's tackle price cycles and uptrends. So let's look into trend analysis very quickly. Now, understanding a trend is actually fairly simple to understand. When the market gets low, it gets oversold. And as the market gets oversold, what do traders or investors start to do? We are taught, guys, I don't even care if you were born and raised in a trading household versus you found it, you came literally fresh off the boat, off the street, and you just found tackle trading and you're just, right now, this is your first introduction to technical analysis. Understanding a trend is not difficult. Understanding why a trend moves the way it does is also not difficult. Understanding where to move within that trend can be fairly complicated at times. But when it comes to a bullish uptrend, first and foremost, you look at the market when it's oversold. And again, I say we're programmed. And I remember being a young man in the 90s, it was really kind of my first introduction to the market in just listening to people talk about trading and listening to people that I grew up with. And I didn't grow up in a Wall Street family, guys. I grew up in a small business environment in a very small community. It was coal driven. It was farming. It was ranchers. It was central Utah. And I don't need to detail it any further because I think you get the drift there. When it comes to that world, we don't understand how all of this works. But you know what those individuals were taught how to do? Buy a dip. You know what people on Twitter are always talking about? BTFD, buy the dip. And what that is it's that mentality is when the markets are coming down, 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 in the back of everybody's mind, they understand what happens to the market long term. I want everybody to answer here. What happens long term to the market? Does it go up or down long term? If you look at any trend of the stock market for the last 10 years, for the last 50 years, for the last 100 years, what does the market have a tendency to do? It has a tendency to go up, 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 up. And so when people come into the market and they are not trained market assassins, but they understand that markets have a tendency to go up over time, the buy the dip is when markets are going down, 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 down. And all of a sudden, we are all programmed to come in and buy that dip. Now, as a trader, where we buy that dip is very important. We'll get into that here in just one second. As the market, as more traders start to buy, it gets a little overextended, gets into the what's considered overbought. Traders start to slow down. And instead of actually pushing that stock higher, what do? They start to lock in profit because the only way to actually make money in the market is to hit that sell button, right? So they hit the sell button, all of a sudden the markets come down, 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 and it just repeats itself over and over and over again. When you're looking at a trend in a simplified pattern, it simply looks as this. You have a series of higher highs, higher lows, higher highs, higher lows. And so from a psychological perspective over time, traders are constantly justifying buying a higher price, and they're also justifying buying a higher price. So they buy a higher price, they sell a higher price. They buy a higher price, they sell a higher price. And I call that walking up the stairs, right? Every step you take is a little bit higher. The resistance level is a little bit higher. And it just repeats itself over and over and over again until it doesn't. So when I identify a higher high, higher low, higher high, higher low, and now we're looking right here at it, the next higher low, what are we traders programmed to do? Just repeat the process. We come in at support, we come in when it's overextended to the downside, and we push that market back up into the next higher high. So when it comes to trading, what I want to do, guys, is I want to go into the market, and what I want to do here is as I go through the presentation tonight, I'm going to pull up an example and we're going to walk through that example as we're detailing some of the concepts that we're going through tonight. And so we just talked about trend analysis and identifying a specific trend within a marketplace. Well, when you're looking at CarMax here, CarMax was on our options report from this previous weekend. When you're looking at CarMax here, you got a very specific trend, and it's very simple to understand. You got a higher high, higher low, higher high, higher low. Now, as the market is building support, and I'll get into that here in just one second, once again, higher high, higher low, higher high, higher low. Market gets overextended, traders lock in profit. They repeat the process. Market gets overextended, traders repeat the process. It has a specific rhythm to it to a certain extent. So if this pattern, and this is just the question we always ask ourselves as traders, guys, we've identified the historical trend, higher high, higher low. What's the next movement? Because that's the real question here. Everybody and their dog can identify what historically this stock has done. Historically, in the last month, this stock has went from 122 all the way to 145. Now it's kissing against 147, right? But in that time frame, it went from 122 to 144. It retraced back down to 135, went back up to 155, came back down to 145. That's the trend. That's the higher high, higher low. So once again, we're sitting at the higher low. If the pattern repeats itself, where's the next movement? If the answer is to your, and again, we have to answer that, right? Some traders might come in here and be like, Oh, I don't like the rounding bottom here. I don't like how long it's taken to confirm. Traders can nickel and dime things all the time. You have to answer this question for you because you are the one that is making the decision for yourself. We like to take control of tackle trading, by the way. So in terms of this, where's that next leg up? Well, if the answer is the next leg up, is that next higher high? Well, the trader has everything they need to go out there and take that next step. And what's the next step? Prep the trade. Before you place the trade, you got to identify, where am I putting a stop loss? Where am I targeting? Where am I entering? All of those we'll kind of get into here later on tonight. But right now, what we want to understand is what is the trend? And based on the trend, where is the most likely next occurrence? Now, excuse me. Now, coming back to the presentation here very quickly here. I got a little cough, so excuse me for that. So come back to the presentation. So once again, in the bullish uptrend, higher high, higher low, higher high, higher low, higher high, higher low. This is CarMax right here. We just saw the stock. Where does it go? Well, based on probability, it would move up to the next higher level of resistance. Now, in a bearish downtrend, guys, and I'm not going to spend a lot of time on bearish downtrends tonight, really kind of focusing on the buy side of the equation. But when it comes to a bearish downtrend, ladies and gentlemen, the picture is the exact same. There's no difference. Like when you ask traders, like traders who are educated, when you ask them, they really don't care if markets go up or down. They honestly don't. They just care that they open and they can do something. If markets go up, they'll position themselves to be as net buyers. Markets go down, they'll position themselves to be net sellers. I mean, Jesse Livermore, kind of the theme of tonight, said it best: buy stocks that go up and sell stocks that go down. Like again, we don't have to make it complicated. You can make it complicated if you need, but it doesn't need to be complicated. When it comes to a bearish downtrend, it's literally flip that chart upside down. You have the same mechanics, but instead of a series of higher highs, higher lows, you now have a series of lower lows, lower highs, lower lows, lower highs. When you look at the pattern in a more simplified version, it is simply a series of lower low, lower high. And like we were walking up the stairs, now we're walking down the stairs. And every step we take down is a lower level of support and a lower level of resistance. Lower low, lower high, lower low, lower high. And so when you look at that trend and you have this lower level of resistance here, where is the most likely destination? Where's the immediate next movement? Well, I would say down, right? That's the trend. That's the pattern. That's what the stock's been doing. I'm not the trader. Tim's not the trader. M's not the trader. Nobody at Tackle Trading is the trader who is going to say this is the moment where this 6-month downtrend is going to get over. What those traders will say is this: if support holds, that's when we'll talk about reversal analysis. But until that happens, until support actually holds, the trader is just a series of lower lows, lower highs. Lower lows, lower highs. When you look at a bearish downtrend, it's going to be a little bit more volatile. When you're looking at, for example, Fate Therapeutics here, I love this example here, and I'll talk to you about why here as we start detailing a little bit of a pattern recognition. But when you look at this trend right now, what is the trend right now? Based on everything I just taught you, based on everything in just trends here, what is the current trend? If you understand pivot relationships, the answer should be neutral. That's the answer. That's the current trend. If you said bearish, it's because you're looking at the previous trend. That was a series of lower lows, lower highs, lower lows, lower highs, until what occurred? Support held, came back into resistance. And so the current trend is neutral. The preceding trend was bearish. Now, where's the beginning point of a new bearish downtrend? Well, quite frankly, it could be happening literally right now, as you are now threatening that support level. And the reason I wanted to bring up this case study, guys, is when it comes to bullish trends, we love the consistency of the higher high, higher low. We love the consistency of the higher high, higher low. When it comes to bearish downtrends, we love that too. There's no doubt about that. We love a lower high. There's no doubt about that. But wow, 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 do we love bearish breakdowns? I don't think there's a, I do not think there's a pattern in the market that traders are more confident in than a bearish breakdown because of what can happen following a bearish breakdown. As you can see here, once support got violated, boom, boom, boom. It dropped like a rock 10 points in a matter of no time frame. And so it's important to understand the lower low, lower high, lower low, lower high, but also when it comes to understanding the beginnings of a new trend, this is starting to occur right now because you now have the violation of support. And so when it comes to the actual trend in identifying the trend here, and again, I'll get my drawing tool very quickly. Once again, lower low, lower high, lower low, lower high. It comes down and now it's going down again. It's a little bit of a hesitation in trend analysis, but I just wanted to bring that up to show you a little bit of a bearish example of a lower low, lower high, and then the beginning points of that next bearish downtrend. And we'll get into that here in just 1 second. Now, when it comes to, and let's go back here. When it comes to pattern recognition, guys, once again, swing trading is all about technical analysis, but it's all about understanding this story as told over time, in my opinion. You first start with the trend. What is the trend? You just got to answer that. It doesn't have to be complicated. You don't have to get into advanced techniques. Just what is the trend? Are you walking up the stairs or are you walking down? Do you have a series of higher highs, higher lows? Do you have a series of mixed results? Do you have a series of, lower lows, lower highs? Identify the trend so you know the direction you want to trade. That's the only thing trend answers is direction. That's it. Bullish uptrend, I know I want to be a buyer of call options. I know I want to be a buyer of stock. Bearish downtrend, I know I want to be a shorter of stock or I want to be a buyer of put options. I want to take advantage of the directional nature. But there are specific patterns that happen within a trend that are vitally important to swing traders. Pattern recognition is literally in our DNA, guys, in our DNA. From the time we are born, we identify patterns. It's in our human nature to identify pattern recognition. Patterns have a tendency to repeat themselves over and over and over again. And when it comes to the market, guys, I give this analogy of looking up at the nighttime sky. And in one time, many, many years ago, and I'm not going to go through it today, I remember teaching my daughter, who was 7, 8 years old at the time, how to find the Big Dipper. And I'm sure many of you parents out there with children, you probably taught them how to see constellations in the nighttime sky. And when you look up at the nighttime sky, especially in central Utah, wow, it is beautiful. I mean, on the ground, maybe not so much. In the sky, beautiful. And when you're looking at that nighttime sky and there's no pollution, so you can see everything, it's just a billion stars. And where's the first star? Where's the last star? And I remember teaching my daughter how to identify the Big Dipper, and she just couldn't do it until I pointed out the pattern. And I pointed out, well, there's 3 stars here, and then you go like that, and you draw it there, and then I drew it here, and all of a sudden, once she understood what to look for, she could identify whenever she wanted to. Same thing with all the constellations, Orion's Belt, Big Dipper. It really doesn't matter. There's patterns that develop through that, and it's been in our DNA since the creation. And when it comes to patterns in the market, guys, it's the same thing. You pull up a price chart, you're going to see a million things. You pull up a price chart, and it doesn't really matter. Let's go with, let's just say Apple here. Oh, man, look at all those candles, trend lines, momentum changes, short-term, long-term, you name it. There is a million patterns here, and it can be extremely overwhelming, guys. It can be extremely overwhelming when you're trying to combine patterns within trends, candlestick patterns, single candlesticks, multiple candlesticks, trend patterns. I mean, it can be very, very overwhelming to the same degree that it's extremely overwhelming when you're 8 years old and you're looking up at the nighttime sky and you see a billion stars and you don't know what to look for. until somebody sits you down and says, here's the Big Dipper, here's a bullish retracement, here's the Little Dipper, here's a breakout, until a trader who has been trained sits down and says, this is the pattern, this is what we do, it's really, really, really complicated. When you look at candlestick patterns, dojis and star classes and haramis and engulfing candlestick patterns with all the momentum associated to those, when you talk about technical patterns where all these candlesticks make up a pattern in the marketplace, you have reversal patterns like M's and W's. You have continuation patterns like the 1, 2, 3 pattern we're going to get into here in just 1 second. You have continuation patterns like high bases, ascending triangles, symmetrical triangles. These are all patterns that happen at the end of trends, okay? And this is where the complicated nature of trading can really get overwhelming, is at the end of a trend in terms of identifying or thinking, yes, I know CarMax has been going up in a very consistent, repeatable pattern, but in the back of my mind, when's that going to end? What if it goes down this time? Oh man, I should have oh man, I wish I could have went back 2 weeks ago. I wish I could have went back 4 weeks ago. Well, guess what? Traders were saying that exact same thing then as they're saying today. It repeats itself until it doesn't. And that is something that you have to live by as a trader. There's always going to be a reason not to do something in the market. There always is. Oh my goodness. Did you see this economic report? Guys, the PCE report is coming out on Wednesday. I mean, maybe we should just wait for that. But then, the market's kind of just opened up on Friday. Maybe we should wait for that. You know what? The Fed minutes are coming out on Wednesday. Maybe we should wait for that. The Santa Claus rally's been going on. I really wish I would have stuck in the halftime report 3 weeks ago when we were analyzing the Santa Claus rally and it was just beginning. What ifs, could haves, and should haves? Traders got to make decisions today, because 3 weeks ago, we were having those same debates, but the traders took action on it the same way the traders are taking action today. You always got to live in the moment and trust your historical understanding of technical analysis. And so when it comes to the patterns that happen at the end of a trend, it can be extremely complicated. And most importantly, it's complicated up here. The picture on the chart's not complicated. The picture on CarMax isn't complicated. But when we start thinking about the would haves and could haves and should haves and the hypothetical variables of what might happen in the future, it becomes very complicated, because emotionally up there, we're not secure yet. When it comes to that bearish downtrend coming back, and again, now we're focusing on the pattern within the trend. Once again, the bearish downtrend, lower low, lower high, lower low, lower high, lower low, lower high. We have a series of lower lows, lower highs. We want to take advantage of that. The simplified pattern, simply lower low, lower high, lower low, lower high. Now what I want to do is I want to introduce you to what's called the 1, 2, 3 pattern. Now, the 1, 2, 3 pattern is basically the 3 general patterns that develop within a trend, okay? Now, once again, at the end of a trend, there's a lot of different patterns. At the end of a trend, you have continuation patterns, you have reversal patterns, and they're very, very similar in those patterns, okay? But within a trend, you have 3 patterns, and I call this the 1, 2, 3 pattern, right? It's a little bit of a dance, okay? Everybody write the number 3 down. Everybody write that number 3. Number 3. You have 3 patterns within a trend. You have 3 candles that confirm a pivot, okay? Once again, the number 3 is very important to us. Once again, the number 3 is very important to us. 1, 2, 3. Now, when it comes to the beginning point of a bearish downtrend, or the beginning point of any trend for that matter, it first has to start by breaking something. If it's bullish, it will break resistance. If it's bearish, it will break support. When support or resistance is violated within a neutral condition, that is the beginning point of a trend. And by the way, That is the number one position trader trigger, is the very beginning of a trend. Not a lot of swing traders will nail that number one because they're waiting for patterns to develop and the consistency to develop. Don't get me wrong. As a swing trader, we'll drill that. But a lot of times it doesn't even get in our scans until it's trending. A lot of times it doesn't even get out there in the lexicon of the social media environment until it starts to move. And so we just simply will miss a lot of the beginnings of trends as active swing traders because it's not what we're looking at. It's not in our scans and so on and so forth. Position traders love this. Position traders love point number one because you're at the very beginning of a trend. And again, what's the entire purpose of the position trader? Well, the entire purpose of everything we do in the market is to protect money and to make money. But the purpose of a position trader is to capture the entirety of a trend, whereas the mentality of the swing trader is more about capturing patterns within trends. And so when you're looking at the 1, 2, 3 pattern, it first starts with the violation of support. When you violate support here, that is number one. That is the very beginning of a bearish downtrend. That's where we want to short the stock, buy put options, take advantage of a market that is moving towards the downside. Now, remember that overextended coming back up into resistance based on the accumulation and distribution of the Wyckoff price cycle that we just talked about in that series of higher highs, higher lows in a bullish uptrend, or the series of lower lows, lower highs in a bearish downtrend. As the market violates support, you'll see this quick drop in price and it gets a little bit overextended. Now, guys, there's a very specific reason why markets don't just go down and markets don't just go up. They go up and they go down and they go up and they go down. And guys and ladies and gentlemen, they don't go up and down based on mom and dad and 401k investor in the world making decisions because let's call a spade, guys. They don't make decisions. They take money out of their earned income and they park it in a 401k every single 2 weeks, every single month. They're parking money, which means it doesn't move the price that much over time. It is the active traders. It is the algorithms. It's the institutions. It's the big money that is coming in and out of the market by making trading decisions that is driving the pattern within a trend. And so when it comes to that pattern number one, where you see that initial violation of support, the reason you start to see that drive down in price fairly quickly is not because mom and dad and 401k investor in America is selling their stock. Let's face reality, guys. They don't know it just violated support. They're not familiar with it. It's not a priority to them on it. And I'm not being critical in that in any capacity. It shouldn't be a priority. They shouldn't be looking at their stock on a daily basis because if they did, they'd probably be making some bad decisions on the price fluctuations. They are parking money. It's the active traders that are getting in and out that is actually driving the price fluctuation. And so when it comes to that pattern number one, that initial drive down in price, we look at shorting at that point, and then why does it come back up? Why does it drive into pattern number three? Is that because all investors are looking at this and saying, let me invest in this stock that's going down and just got hammered? No, not at all. That's not what is happening here. What is happening here as the market gets overextended in pattern number two is the traders who shorted in pattern number one. Well, guys, to enter a short position, you have to sell the stock. Now, you don't have to own the stock, but that's a webinar for another time. You have to sell the stock. To close the trade, you have to buy it back. And that art of buying back a short will actually drive the market back up. And so all you're seeing here in pattern 1 through 3 is simply traders looking to drive the stock down and then it drives back up through them locking in their profit by buying back the position. And then that's what we look at in the bearish 1, 2, 3 pattern. You look at the breakdown, which is pattern number 1. So number 1 is breakdown. Pattern number 2 is overextended. That's where the bearish trader locks in profit. It drives it into pattern number 3, which is called the bearish retracement, the retest of the old support break, and then we just start walking down the stairs. Now, pattern number 1, everybody loves. Swing traders, position traders. Everybody loves it. Pattern number 2, obviously you're looking to lock in profit. Pattern number 3, we're looking to reset the position. Now, once again, coming into the bullish uptrend, you have a series of higher highs, higher lows, right? We talked about this when we were detailing trend analysis about 20 minutes ago. You have the oversold, overbought, oversold, overbought. The simplified version of the Wyckoff price cycle is a simple series of higher highs, higher lows, higher highs, higher lows. And we walk up the stairs. Well, when it comes to the actual patterns within that within that trend, we label them a tackle trend, the core 1, 2, 3 pattern. Once again, we talked about the 1, 2, 3 pattern on the downside. That started with a violation of support. Well, what starts a bullish uptrend? Well, what starts a bullish uptrend is you first identify where resistance is, right? You got to have pivot confirmation. You got to identify where that resistance level is. Well, we've identified that resistance level right here and right there. And so in the halftime report, you'll hear me say a lot in the halftime report, I don't care what happens between these two price thresholds, okay? Because within that neutrality, traders don't care. It can go up and down for as long as it wants to do. We do not care. What we care about is when it breaks out. That breakout, pattern number 1, is the beginning point of a new bullish uptrend. Now, we detailed the types of traders earlier today, and we talked about position traders and swing traders when we were doing the bearish cycle. From a bullish cycle here, pattern number 1, the beginning point of a new trend, what type of traders are going to be attracted to this? Obviously, if it's a stock that a swing trader's following, they're going to nail this, no doubt. They'll probably have an order above resistance if it's a stock on their watch list. If it's a stock not on the watch list, they'll probably miss it, okay? But they love pattern number 1. A breakout, ask Coach Frank, the breakout king himself. He can't say no to a breakout. Come to the halftime report on Friday. Actually, not this Friday because we won't be there. It's Thanksgiving. By the way, happy Thanksgiving. Hope you guys have a wonderful, wonderful Thanksgiving and weekend. But when Coach Frank comes on to the halftime report with me next Friday, we're going to geek out on about probably 30 stocks just from a technical perspective. And I'm willing to bet we'll play a little game called Frank's Charts at the end where he takes 4 charts, I take 4 charts. I guarantee I'll get him out 3 out of 4 just on breakouts. He can't say no to a breakout. He loves it because of the momentum behind a breakout. He loves that momentum that can occur after you break out. That is the breakout. Pattern number 1 breaks out. Traders are attracted to it. The position traders, the traders, the active swing traders, everybody starts getting attracted, drives the price up, 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 gets into the overextended. Now, why doesn't the stock just go up forever? Why doesn't it go up forever? Everybody makes money. Well, if everybody makes money, nobody makes money because money's worthless. Traders make money by locking in profit. Investors make money by locking in profit. To lock in profit, you have to sell the position. And so in pattern number 2, as it starts getting overextended, we look to lock in profit. By locking in profit, you first buy in pattern number 1, thus you sell in pattern number 2. That drives the market back down collectively as market participants. That drives the market back down into pattern number 3, which is the bullish retracement. And so when you're looking at the 1, 2, 3 pattern, we basically identify this and we simply trade it over and over and over again until what occurs? Until it doesn't work. And when it doesn't work is when support is violated. And so when it comes to the 1, 2, 3 pattern, let's go back to our example of CarMax here. Now, the trend we were looking at earlier tonight on CarMax was a series of higher highs, higher lows, higher highs, higher lows. Now, at the higher low, we're obviously trying to walk up the stairs here. At the higher low, where's the next projection? Well, the next projection would be a higher high. Okay. Well, if that's the case, then the trader will come in and prep the trade, and we'll do that here in just a moment. But when you're looking at that 1, 2, 3, I want to look at this from a little bit of a different perspective and a little bit more time frame, because we now are starting to understand as new traders, and welcome out to Tackle Trading, all you new traders. You guys are the best. You're going to love our community. Make sure to hit that subscribe button, by the way. But when it comes to this, to the new trader here, to the veteran trader, they're looking at CarMax. They're like, yeah, man, this is awesome. Let's go above 150, stop under 145. Let's target 166. Let's rock, right? The veterans of tackle trading, they know this old hat to them. They understand all these concepts. They understand where that trigger is. They understand what I'm going to say before I say it, most likely. Okay. But I'm talking to the new trader who just found tackle trading, who is interested in learning how to trade, who has an interest in trading in general. To the new trader out there, we just learned how to identify a trend, the series of higher highs, higher lows. We just went through the specific patterns within a trend. We didn't detail the 36 different continuation and reversal patterns, because that's not what's important to a swing trader who is based on trend analysis. We want to identify 3 patterns: the breakout, the overextended pattern, and then pattern number 3, which is the retracement. Well, when you're looking at this from a little bit of a bigger picture, once again, when you come back to that bullish example we were looking at, look at the neutrality here, look at the breakout there. Okay. Now let's come back to CarMax here. Let me draw a couple things for you guys. First and foremost, the trend before this breakout, the trend before the breakout, what was it? Before CarMax broke out and it is now in this series of higher highs, higher lows, what was it? It was neutral, right? You had no pivot confirmation, bullish or bearish. Pivots, both at 122, both held. Resistance, both held. Now, when you're looking at that from a little bit of a bigger perspective, right here, and let me get my drawing tool very quickly. Right here is pattern number 1. That's pattern number 1. That breaks out the previous trend. Now, to those traders who understand what front running is, you're going to love that bullish retracement as you were building into that, but that's not the point of this conversation. The point of this conversation is identifying when the trend starts getting consistent. Now, right there is pattern number 1. Now, pattern number 2, we know things get overextended, right? Things get overextended, correct? Yeah, they do. They get overextended. And when they get overextended, what do traders start to do? What do we program to do? What are we taught to do? Pattern number 2. We're trained market assassins. Step system, trained market assassins. Gets overextended? Well, we lock in profit. That's what we do. We're traders. We're not positioned here. We're not investors. We're traders. We don't, man, take CarMax off the stock. We don't care. I don't care if that's saved CarMax. That could be Bitcoin. That could be anything besides, well, there's a couple of stocks out there that I would say no to, but that could be Bitcoin. That could be a currency. That could be a stock. That could be anything out there. We don't care. We like the breakout. Pattern number 2 gets overextended. We lock in profit. That locking in profit drives the price down until where? Until it gets into pattern number 3 right there. So here we're looking at a bullish case study with a series of higher highs, higher lows in the short term. The bigger picture confirms that pattern number 1 is broken out of. And ladies and gentlemen, we have the first retracement at the beginning point of a new bullish uptrend. Now, from that perspective, where are we now projecting this stock to go? Because that's what we're really learning how to do here, guys, is we're learning how to really what we're learning how to do is how to identify pivot and when to take advantage of opportunity. So we have a series of higher highs, higher lows. We just broke out in pattern number 1. We got overextended. We retraced into pattern number 3. Where's the most likely destination? Yeah, I agree. The most likely destination is back up higher, the same way it did it here that led to the breakout originally. So all of a sudden, now we have this consistent bullish uptrend where now we have some confidence in that support building. And so I wanted to take a moment to identify that same degree of pattern on CarMax, because that's what we're looking at. You have that nice little neutral, it breaks out, gets overextended, retraces back down, and then we just start walking up the stairs along with CarMax there. Now, let me take it off my screen here. Now, let's talk about the third thing. Remember, there's 3 things I wanted to talk about tonight from a swing trader. Number 1 was the art of trend analysis, identifying bullish uptrends, bearish downtrends. That's the Wyckoff price cycle, right? The overbought, overextended zones, okay? Then we looked at simplifying the pattern, series of higher highs, higher lows, higher highs, higher lows. Then we took it a step further and we said, okay, we first understand the Wyckoff price cycle from a trend analysis perspective. Then we understood the simplified version of it. And then we're looking at the specific patterns within a trend. You're starting to see how that story starts to be told over time. So we looked at trends, we looked at patterns. Now let's identify where to buy versus where to sell, because that's what support and resistance is all about. Now, support by definition, ladies and gentlemen, support by definition is an upward movement in price. Okay? That's what the definition is. It is an upward movement in price. Resistance, on the other hand, is a downward movement in price. Now, there are many ways we can identify support and resistance in the marketplace. That is what is referred to as technical catalyst. Okay? So once again, you have what is support. That is an upward movement in price. You have what is resistance. That is defined as a downward movement in price. Remember what Jesse Livermore said, buy stocks that go up and sell stocks that go down. Traders like to make it simplified, ladies and gentlemen. The complicated nature of support and resistance is not the definition. The complicated nature of support and resistance is identifying where it is from a catalyst perspective, and then watching the market build it to confirm that as support perspective. And we'll talk about CarMax and the example of CarMax here in just 1 second. Before we get into the actual how to identify support, I want you to look at my good friend. Now, many of you guys know who Marty the Elephant is. He's the mascot of tackle trading. Marty is also one of my good friends. And I can't remember where I was at this point. It was somewhere in Texas, probably most likely Dallas. And I was teaching a 3-day seminar down there a few years back. And there was an individual who was really struggling with the concept of support, just really struggling with the concept of support. And I said, do you like to jump on a trampoline? He said, yeah. Who doesn't like jumping on a trampoline? I dare somebody to go jump on a trampoline and frown. It's fun. You like jumping on a trampoline. I said, well, let's say you and I went out and we start jumping on a trampoline. Well, what is the trampoline? In this example, what is that trampoline designed to do? It's designed to stop the whatever's jumping from going lower. That's the design. Well, the trampoline, therefore, is support. The trampoline is a support catalyst. Now, does that mean trampolines can't be broken? No, heavens no. Of course a trampoline can be broken. And so I said, well, what if it was not you and I jumping on that trampoline? What if it was a 64,000 pound behemoth called Apple or Google or an elephant? And an elephant was jumping on the trampoline. Could an elephant break that trampoline? Oh yeah, Matt, elephant, 2,000. Yeah, that elephant would destroy that trampoline. I said, well, let me introduce you to a good friend of mine called Marty the elephant. Now, I want you guys to understand who Marty is to me. Marty represents technical analysis. And quite frankly, I think for me, Marty represents every aspect of technical analysis. The conversations of support and resistance, momentum and how it builds into support and resistance, confirmation and stop loss placement, targeting, potential average yield, everything. Everything technically, I think if you can understand why Marty the elephant goes up and down on that trampoline and where he goes up and down on that trampoline, that's all traders do. Because all we do as traders is say, well, what's the historical pattern? What has it done historically? And let me position to take advantage of that same historical pattern in the future. Well, Marty the elephant is jumping on this trampoline. But once again, I know it's hard not to look at Marty, guys. He's so cute. He's such a cute little elephant. But it's the trampoline I really want you guys to focus on here. Because the trampoline is that concept of support, where that support stops the movement from going lower. And you got Marty the elephant, this big old elephant coming in with some heat. And what happens? He hits the tramp, he slows down, and he projects and explodes back up. Well, we'll come back to Marty here in a second. When it comes to the concepts of support and resistance, once again, support is always underneath the stock, resistance is always above the stock. So support's here, resistance is here. Now, support is the floor. Remember, if I'm walking up those stairs, support is the floor, right? Support is the floor. Now, what creates support is when you see a shift in the supply and demand argument. And so what drives the stock up when it breaks out, like CarMax broke out a month ago, right? Well, what drove that up was you had increasing demand against the supply. Simple way to put it, you had more buyers than sellers. You have more buyers than sellers, demand pushes up, stock goes up. Well, when support is built, it's because the stock is coming down. So the stock is coming down. And it's when that balance between supply and demand, when that shifts, you see support start to build. And so what happens as the market is coming down, it's coming down because there's additional supply. You have more sellers coming into the market than you have people that are willing to take the position. And so that stock is driving down, more supply. Nobody's taking it, keeps coming down until demand overcomes the supply. Think about buyers. We like a discount. So if it's not discounted here, well, we'll wait. We like a discount. Everybody likes a discount. Well, that supply drives it down. And then what happens is you start to see demand overcome supply, and that drives the stock price back up. That is what confirms support, is you have increasing demand against the supply. That is the definition of support. And so when you look at it from a candlestick perspective, and guys, in the step system, I do a whole session too on candlestick analysis. But for here, when you're looking at candlestick analysis, you just see these red candles coming down, and they got some heat to them, right? They got some heat. They're coming down pretty aggressively. Well, guys, what's going to slow it down? Support is. And when you start to see support build, it's done from a visual perspective. And what we're trying to look at is you see a stock going down, and the widths or the lengths of the candles here, they're actually increasing to the downside, showing you increasing momentum. Well, what happens is as support is starting to build in the market, that momentum starts to slow down. And so we never just want to buy my old man said it better than I was just about to. You never want to catch a falling knife, right? You never want to catch a falling knife. You want to let it hit the ground, stop, and then pick it up. Same concept applies here. You never want to catch this falling knife. That's a dangerous thing to do as a trader. You want to let it slow down and then that support to start building. And the first thing we love to identify as the first stages of a support build is you like to see the candle start to shift its momentum. And so you go from big red candle, which are big, scary, big red candles, right? Well, you'd like to see that slow down first. That is the concept of slowing momentum. But what you're really seeing there is you're seeing support build because buyers are coming back in to offset the sellers. That's what a doji is in the marketplace. It's a narrow candle that has basically equal amount of buyers and sellers in it, but it's a key reversal analysis technique because the preceding momentum was all controlled by sellers. Sellers were selling. Now, again, I'm not talking about people shorting. I'm just talking about sellers. People who own the stock is selling the stock. Traders that own the stock are now locking in profit because it got overextended into pattern number 2. And so whatever's causing the selling is not a discussion for us. We really don't care. What we care about is the bullish uptrend, the pattern, and now that support is starting to build. And so when you see these candles here, and guys, I'm not saying it's as easy as just big red candle and big green candle, but it is for now. Okay, it is for now. For now, we don't need to know what a bullish harami or an engulfing candlestick or a dark cloud cover or a piercing line. We don't need to know those yet. We can know those over time. But for right now, keep it simple. Keep it simple. The KISS method, right? How many of you believe in the KISS method? I certainly do. Keep it simple. And so when you're looking at those big red candles, big scary red candles, right? They're not scary. Just means more sellers and buyers. That happens all the time in the market. What it tells us is that it's going to continue to go down. That's the momentum. Momentum has a tendency to continue in the direction of the momentum until something changes. And remember who said that? It wasn't me. It was, who was it? It was Isaac Newton, right? Things in motion have a tendency to stay in motion. That's all a big red candle is. It's in motion. There's more sellers than buyers. So don't fret. Don't get emotional. Just allow it to subside. Allow it to slow down. And what we will see is we will see the visual representation of support building based on the fact that the candles are now contracting and buyers are coming back in the same way my good old friend Marty the elephant does when he hits that trampoline. And I'll get into that here in just one second. And so the concept of support is so vitally important to us, but how it is created within an uptrend is told through a series of understanding where technical catalysts, well, first of all, let me backtrack. What is a technical catalyst? Where is that technical catalyst? And then the discussion we're having currently on the candles and how that visual representation of slowing momentum is actually support building in the market. And through this story, it is also telling the active trader that they need to take action there as well. When it comes to resistance, resistance is always above the stock. Resistance is the area on the stock where we expect that downward movement in price. And so as the stock is going down, it's because additional supply against the backdrop of demand. Well, on the top side, you have increasing demand. Like, for example, buyers come in, buyers come here. Great stock. Everybody wants to make money. It's going to go to the moon. It doesn't matter what the psychological things we tell ourselves up here. It's increasing demand. Whatever the reason for that, let other people debate that. We as the trader just care about what? You have increasing demand, which is driving the stock up, and things in motion have a tendency to stay in motion until an object appears that stops the motion. Well, that object that we're looking for is the same concept as support building. Now we're looking for resistance. And so demand's driving the stock up. As it gets a little elevated against the current short-term price action, traders are going to obviously start saying, I'll tell you exactly what they first start saying. Before they start saying, look at them start to sell, that's not the first thing. I've had this discussion 1,000,001 times, literally in the scouting report meetings just in the last couple of years. The scouting report meeting we do every Friday. And every Friday, the coaches of Tackle Trading get on and we analyze the markets. We put our reports together, the stock, the options, the commodity report. We put our pick list together, and we put the Tackle Trading newsletter together, and we get that out to our community by Saturday so that they can have access to everything we're looking at going into the next week. When we're going through those picks, one by one, coach will throw out a pick, we'll analyze it as a collective. As we're going through that, the question first and foremost is not about, oh man, are they going to start selling? It's has it already made its move. And if its stock is already in a move by 4, 5, 6 days, it's not even a matter if they're seeing resistance form. It's the fact that they missed the trigger on the support bounce. Resistance forms with slowing momentum, okay? And so when you're looking at resistance, it's the same conversation we were having with support. As support builds, you start to see momentum build, big green candles. Everybody loves a big green candle unless you're the shorter, right? Everybody loves big green candle. Big green candle. Big green candles represent what? Increasing demand against the backdrop of supply, correct? Oh, yes, that's accurate. You're technically accurate. They represent buyer's momentum, bullish momentum. Momentum has a tendency to do what, ladies and gentlemen? It has a tendency to continue in the direction of the preceding movement until an object appears to stop the momentum. Now, again, that object could be a lot of things in the marketplace. For us technicians, it's not. For the market, it is. For the market, it could be an economic report. It could be a fundamental analysis. It could be the central bank said something, did something, didn't say something, didn't say, like, it doesn't matter. The market's going to geek out on 1,000,001 things about, they try to understand the context of everything. Whereas the trader is just like, it's a slowing momentum candle. It's a smaller candle than the preceding candle. I don't care what the news was to stop the momentum. All I care about is the momentum is stopped. Whatever the causation is for other people to debate, discuss, have discourse over it. That's why I love technical analysis, is it simplifies the entire marketplace. It is my favorite form of analysis. And guys, for those of you who have never been to the halftime report, it doesn't mean I don't love behavioral analysis. I do. I geek out on consumer spending and consumer reports and retail sales and inflationary reports and economic analysis as much as the next guy, probably a heck of a lot more. But I love technical analysis because it simplifies everything. It doesn't matter what people say, what they believe. We see the actual representation of momentum and their beliefs in that stock on the price chart. And so when we see a big green candle, what are we going to say? Well, that big green candle has the tendency to continue in the momentum of the preceding candle. Fantastic. Well, until what occurs? Well, until we see that slowing momentum candle. Now, as that momentum starts to slow, what's causing the slowing momentum? What is causing resistance to form? It doesn't matter. All we care about as a technician is the momentum has shifted. The momentum is shifting. Wall Street's shifting. You and I are shifting. Mom and dad are shifting. Everybody's shifting. We're shifting. And so all of a sudden, you start to see the visual representation of resistance form. And so when it comes to identifying where support and resistance are going to form, that is what we call a technical catalyst. How it forms in real time is a lot based on momentum, and it's based on the momentum of the candles to a certain extent. Now, when it comes to where that momentum has a tendency to shift, this is where the old Boy Scout model comes into play here. Be prepared, right? Because you can see slowing momentum in any stock at any time. It could be a random Tuesday where, oh, wow, nothing is occurring. Right? Nothing is occurring, like no economic reports, no political events, no earnings reports. It's just a very, 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 very boring day in the marketplace. It could easily just be that. Where the momentum shifts, though, If it's based on where you're identifying a technical catalyst, where that is supposed to shift, that means everything to us as traders. And so once again, the definition of support is an upward movement in price. The definition of resistance is a downward movement in price. We've talked about what creates that. We've talked about the mentality of it. We've talked about the visual representation of it. Now let's talk about where these areas of support and resistance have a tendency to form over time. Now, for me, and what I do in the step system is I like to focus on 5 different catalysts that can act as support. Now, once again, support is defined by the marketplace, but I like to look at the catalyst of where support could form. Number 1, significant price thresholds. These are what we call significant whole numbers. $10, $20, $50, psychological numbers. Remember, what creates support and resistance? It's not random. It's traders, it's you, it's me, it's traders making decisions collectively as market participants creating support and resistance, right? But where we make those decisions are important. Significant price thresholds are psychological. And so when it comes to the very nature of support and resistance forming based on traders making decisions, I can promise you one thing. A trader will look at $100 vastly different than they'll look at $51.75. Can we all agree with that? You and I, as people in society, when we go to buy a t-shirt and that t-shirt says $19.90, do we go back to our loved one and say, yeah, I bought a t-shirt for $19.97? Or do we just say 20 bucks? Right? We round everything to that significant whole numbers, and significant whole numbers have a tendency to play themselves out as psychological levels of support and resistance. We love $10, we love $50, we love $100, we love $200, we love $1,000. One of the reasons, I was in the halftime report a couple weeks ago, guys, and we were looking at Tesla, and literally, and I'm sure there's pro members here that was in that halftime report. We were looking at Tesla literally on this day here. And I said, guys, all I'm going to say is this. It's $1,000. It's going to slow down. We saw the slowing down. It came down, retested $1,000. Now, what was it about Tesla on this day just randomly slowed down? On the day where Elon dumped $6 billion in shares? Like it just randomly slowed down? Just hypothetically just formed at $1,000? Or was $1,000 a very, very well-known psychological number? And I know some of you probably don't remember Tesla before the split, but we did this song and dance at $1,000 on Tesla before. These numbers have a tendency to really stand out over time. So when it comes to those significant whole numbers, they just have a tendency to play themselves out. And it's not surprising at all when you see the concept of support at $1,000 on a market that was looking like that. Look at this candle here. Look at the heat of this candle, guys. Look at that. Cash open 1175. 30 minutes later, you're down 140 points. And all of a sudden, what occurs? Slowing momentum. Why? Was it because Elon started buying? No. Elon was still dumping the following day. He's probably still dumping stock. What occurred? Traders came in, identified support, and started price projecting. That's what occurred. $1,000 played out as support. That significant catalyst of $1,000. The second one would be known as previous levels of support and resistance. And when you're talking about previous levels of support and resistance, it's very simply this. Old resistance, new support. Old support, new resistance. Previous pivot points that have been confirmed historically will always be at the forefront of traders' mindset when it comes to where support and resistance can form. Trend lines, connecting the dots, drawing trend lines, and quite frankly, drawing accurate trend lines. That can be a powerful way of identifying support and resistance. A very popular way of identifying support and resistance is moving averages. Moving averages have a tendency to track the average over time. Well, you have simple moving averages, you have exponential moving averages. Simple moving averages like the 20, 50, and 200 simple moving averages, they have a tendency to attract buyers, is what they do. They have a tendency to attract buyers. EMAs like the 9 EMA, 13 EMA, they have a tendency to be more momentum-based support and resistance. Moving averages have always acted as support and resistance for as long as I can remember. In fact, the first technique I was properly trained on, because we have improper ways of going through education, the hard knock ways, right? And then you have the proper ways, actually being taught by people who have been there and done that. One of the first ways I was properly taught how to identify support and resistance is just moving averages. One of my mentors said, look at the 20-period moving average. What happens when it hits it? I'm like, oh, it goes back up. All right, then, bye. Well, 50-day moving average, 200-day moving average. You start understanding over time what different types of traders look for different types of moving averages. For example, the 9 EMA, momentum traders love the 9 EMA. Love the 9 EMA. Standardized swing traders love 9 EMAs. They love the 20 SMA. Don't get me wrong, they'll geek out on a 50-period moving average bounce too, but then they get all geeked out and concerned about how deep that dip is. So they typically have a tendency to overanalyze those deeper dips. And plus, those deeper dips mean what? The 20-period moving average, which they love, fell. Well, if the 20-period moving average just fell, I'm not going to be as in love as a swing trader with the 50-day moving average bounce, unless they're real tight against one another. So popular moving averages attract different types of traders from a different time frame perspective. Fibonacci levels, okay? Next Monday, everybody write this down. Next Monday is the mastermind group for the STEP system. And I'm the one who does the mastermind groups of the STEP system. We're going to talk about Fibonacci retracement levels and the psychological nature behind Fibonacci and why they work. And not the funny math, not the, oh my goodness, the mathematical equation of Fibonacci. No. The only reason technical analysis works is because people use it. Either one, they use it to make decisions to buy and sell, or two, they use it to program algorithms. That's the only reason technical analysis works. Outside of that, it's all funny math, okay? So popular Fibonacci levels, they connect as support and resistance. Now, my good buddy, Jesse Livermore, he said this when it comes to the art of confirmation, which is what we're going to discuss right now. Do not anticipate a move without market confirmation. Being a little late in your trade is your insurance that you are right or wrong. You never buy simply because it's sitting at support, simply because Marty's on the tramp, simply because you like the stock, simply because historically it worked out at support. That's not us. That's not us in any capacity. We love confirmation. We do not move without confirmation. And yes, in the STEP system, you do learn the differences between aggressive and conservative confirmation. But once again, do not anticipate a market move without confirmation. You need to see the market move first. You need to see those big dogs move first. You need to see the Buffetts and the Cathie Woods of the world move first. You need to see them move first, because you don't move the marketplace. You got to follow the money. That's what you have to do as traders. Nothing is new in the market. You're not creating anything new in the market. You're not doing anything new in the market. You're doing the same thing that's been done by millions of other traders over time. And they wait for confirmation. Traders wait for confirmation. We do not try to maximize reward to risk ratio without confirmation. Now, because your hypothetical return, if it's not with confirmation, that's a fairy tale. You might as well tell tell the story of the three bears or the three little pigs. It's the same thing. As it means absolutely nothing. Your reward to risk ratio means absolutely nothing if it doesn't have confirmation. If your areas of where you're putting that entry and that stop loss are not properly done, it doesn't matter what you think you're going to make, because the market hasn't told you you're going to make it yet. We do not move without confirmation. Remember, the candle dance that creates support. You have that heat coming in, right? You have that heat coming in, and that heat is a downward movement in price. Well, that heat is what we call the preceding candle. And so the preceding candle is the candle that comes in and hits support. That support is typically one of the catalysts that you have identified that you're willing to trade off of. Whether that's the 9 combination with the 20 SMA or a significant whole number or Fibonacci retracement, it doesn't matter. You as the trader are the one that determines that. You as the trader are the ones that says, I am confident in my analysis. I'm confident in that support bounce. I'm confident in the trend. I'm confident in the pattern. And I'm going to push my chips to the middle of the table because I'm confident in this setup. That is you, the trader, that makes that determination. Okay. But you got to wait for the market to move is what you got to wait for. And so you've identified that catalyst, right? You've identified that catalyst of where that support level could form. The market is coming down with some heat. It hits your catalyst. Well, now you wait for that slowing momentum candle. That slowing momentum candle is a narrow body candle, typically, a narrow body candle that slows the momentum from the preceding candle. But are we ready to act yet, Tackle? Tackle traders, are we ready to act yet? We got a slowing momentum. Marty's sitting on the trap. Marty loves to bounce. If Marty goes up, we make money. Let's just do it, right? Let's just do it. No, Marty's a big old elephant jumping on a trampoline that came down with some heat, and all you have is one day of reprieve from that. That's all you have right now is you have slowing bearish momentum. That's it. Slowing bearish momentum is not an indication of increasing bullish momentum, which is what you need for the market to confirm. And once again, we don't move without confirmation. We move with market confirmation. So we need to see that. And so this dance at that support is very important because you got the heat coming in with the big bearish candle, right? You got that heat coming. It then slows its momentum down with that slowing narrow body candle. And at this point, we're excited, but we're not ready to act. We're excited for the opportunity. We're excited to make a trade, but we're not ready to act. We're ready for confirmation. That's candle number 3. Remember that number 3? 3 patterns, right? Remember that number 3? 3 patterns and 3 candles. 3 patterns within a trend, 3 candles to confirm support. You have your preceding candle. You got your signal candle, which is the narrow body candle. Then you got your upward movement in price, which thus confirms your entire analysis. So everything you did was just you, and more of you up until the market confirmed your opinion. And once that market confirms with pattern number 3, it is go time. Now, coming back to my good friend Marty. Slowing momentum, pattern recognition, support and resistance, triggering, reward to risk ratio, probabilities and edges. Marty has it all. Marty has it all. Everything that I have detailed to you guys for the previous, how long have we been going, Tim? Oh, hour and a half?
About 90 minutes, yeah.
Is in Marty the Elephant. Marty the Elephant. Now, Marty, I want everybody to look at Marty. Everybody fixate on Marty, right? Marty goes up, Marty goes down. Marty goes up, Marty goes down, right? Fixate on Marty. Stare at that beautiful little elephant having a lot of fun jumping on that trampoline. And who knew? Who knew you could learn how to trade by watching an elephant just have some fun jumping on a trampoline? But here we are. Now, Marty going up and down, up and down, and 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 up and down. Marty there. Now, Marty here has a historical pattern to him, right? What does Marty have a tendency to do? First and foremost, Marty has a tendency to go to resistance right there. Now, let's get our little drawing tools here. So Marty, oh, that is a big old drawing tool. We don't want that one there. We want that one there. So that's Marty. That's resistance, right? Now, what happened to Marty? We're gonna bounce Marty again. I want you to focus on Marty, not when he hits the tramp, but when he hits resistance, okay? As Marty is going higher, 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 higher. Well, guys, gravity's still there. And it's harder to keep driving him up the higher he gets, right? That's how gravity works. Well, at some point, he starts to slow down till he has zero movement before he starts coming down. That's Marty slowing down. Marty's the visual identification of resistance forming. Well, then as Marty starts coming down, 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 what does Marty have a tendency to do? Well, as Marty starts coming down, 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 again, look at Marty just going and he dings that resistance every time, right? Just dings that resistance. Well, when Marty comes down, and let me go back very quickly. When Marty comes down and hits the tramp right there, well, now Marty is sitting on support, right? He has that pattern. It goes up and down, up and down, up and down. Stocks go from support and resistance, support and resistance, support and resistance. Now, what if Marty was Apple or CarMax? We were talking about CarMax earlier tonight. Let's say Marty's CarMax, right? And let's come back to CarMax here. KMX. So let's say Marty's CarMax here. Marty jumps, hits resistance, comes back down to support, right? That's Marty jumping right there. Now, when it comes to Marty jumping on my nice little trampoline, do I know? Now, before I stopped Marty jumping, where was Marty coming? He was coming down, right? He was coming down. Now, again, focus on Marty here, guys. It's very important because you can understand the concepts of momentum. Now, as Marty was coming down, he's coming down with some heat, right? Look at that. He slows down on the way up. Look at him slow down. Again, watch him slow down. Watch him come down with some heat. Coming down with some heat, right? He's coming down with some heat. Now, as Marty comes down with some heat, when he first hits the tramp, what happens? Does he automatically go back up? No. Again, the tramp's support, right? It's not cement, it's support. When he first hits support, he slows down. Before he goes back up, he slows down, right? So he slows down. So as Marty's coming down, he's coming down with some heat into support. Well, once he hits support, he slows down to the point where he's now net neutrality. He doesn't have any movement. Well, as the trader, what I can do, therefore, ladies and gentlemen, is I can say, okay, I know where Marty historically goes. I'm going to target where Marty historically goes, okay? Number two, I don't want to buy Marty simply because he's sitting on a trampoline. That's not what I want to do. I don't want to buy an elephant jumping on a trampoline. I don't want to do that. I only want to buy Marty if he does what? If Marty starts jumping again. That's the only time I want to get into the trade is if it starts to move. Well, what we do for you new tackle traders is we like to identify where that resistance level is from an intraday perspective, right? Where's that level on that chart where we see confirmation, where we see that upward movement in price? Because I know Marty's slowing down. I know he's sitting on support, but I got to see that upward movement in price. I have the preceding candle. I have the signal candle. Now I'm only waiting for is what? That strong upward movement in price. And so I simply put an entry order above Marty. So when Marty jumps or when CarMax jumps, we get into the position. We get into the trade the same time frame that the market is also getting excited. And simply put, we put a stop loss under support just in case Marty, my big old elephant, breaks the trampoline. And if it does, so be it. It happens. We get stopped out with taking too much damage. That's Marty the elephant. And so when it comes to the art of swing trading, all we're actually doing is trading my elephant. That's all we're doing. We just call it Apple or CarMax or Microsoft, and we're trading the momentum, we're trading the pattern, we're trying to put orders where historically we can guarantee confirmation, where historically has a tendency to stop its momentum. We're simply trying to identify the pattern and the momentum and the trend the same way we do when it comes to something as simple as an elephant jumping on a trampoline. And I'm sure there's people out there tonight or down the road as they watch this video and they're getting introduced to the market and they're saying, how in the world are we aren't we in a stock webinar? We're looking at Marty the elephant. Because simply this, guys, if you can't overcome understanding Marty the elephant and how we project Marty off a tramp, It's going to be real damn hard to do it on a price chart when you're overanalyzing everything. Keep it simple. Kind of like Jesse Livermore originally said. Buy rising stocks and sell falling stocks. You don't have to make it more complicated than that. Now, let's put it together here on CarMax. First thing we do is we identify the trend. What is the trend here? Bull, bear, or neutral? We don't need to get into the momentum of things, just bull, bear, or neutral. That tells me the direction I want to trade. We have a series of higher highs, higher lows. That's bullish uptrend. Number two, what's the pattern? Well, we identified the patterns within trends tonight. There's a 1, 2, 3 pattern, right? One is the breakout that occurred right here. Let me get my drawing tool. One is the breakout. Two is the overextended. And three is the retracement. Do we have a consistent pattern here? 100%. 100%. So we're at the 3 pattern within a bullish uptrend. Are we setting at support? And has the market shown us Marty has found the trap? Because here's Marty, hits the ceiling, right? Hits the ceiling, down, 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 down. Are we seeing the slowing momentum here? Yes, we are seeing the slowing momentum. Look at the momentum here. Look how it U-shapes there. Look at it working its way back up. Now, what do we do now? Do we need to wait on anything else? I mean, we got the PCE report coming tomorrow. Got Fed minutes on Wednesday. Yeah, we'll be eating Thanksgiving on Thursday. I don't know about you guys. Market is open for a few hours on Friday. Might not be a lot of activity though. Then you got the weekend. Well, what about all that stuff next week, guys? I mean, we're going to be talking debt ceiling next week. We're going to be talking about inflation. I guarantee we're going to be talking about inflation. The PCE report tomorrow. The point is, all of those variables are variables that exist every second of every day, and they have existed every second of every day during this bullish uptrend. Those exact same variables were existed last week as they were the week before, and yet we had a consistent bullish uptrend with a consistent pattern. Let the media overreact to what sells newspapers and clicks. Traders, what do we care about? We care about the analysis from a technical perspective. Number one, we have a bullish uptrend. Number two, the pattern is a bullish retracement within a bullish uptrend. Number three, we are sitting on support at 145. That's all that's important. Now, if I got a good trend and I got a good pattern and I'm setting at support, which we are all in CarMax here, now it's simply a matter of prepping the trade. And prepping the trade is simply identifying where your entry is with confirmation, where your stop loss is, just in case you're wrong, right? A stop loss is the insurance against you being wrong. If we're going to be wrong, we would rather lose a little bit of money than a lot of money. So, third thing is your target. Now, who here is ready for a prep and trade? Based on it, and by the way, have you guys had fun so far? Have you learned something about technical analysis, about trends and patterns and support and resistance and the mindset that goes into these topics and this form of analysis? I hope you guys have had a lot of fun here tonight. Well, what's really fun is taking your knowledge and putting it into action, right? Taking what you have learned and building upon that. Well, now let's prep a trade. Now, first thing I like to do, guys, is I like to get my entry. And everybody's a little bit different, but here for me, if I can't identify a good entry, it doesn't matter. Nothing else matters. I'm going to wait for a better entry. And so number one, you have the slowing momentum. Yeah, I love that hammer candle there. You got to love the slowing momentum. Now, what do we do? Well, guys, you can't. Well, let me put it like this. The concept of confirmation can be debated. And if you put 10 traders in a room, 10 traders will debate this until they're blue in the face. I guarantee you, I've done it. I've been there. They all want to be right. If there's one thing we can all agree on, though, when it comes to the art of confirmation, it's above the previous day's high. Everything else is micro analysis in terms of maximizing that entry. But the generally acceptable principle in terms of confirmation is always above the previous day's high. If it doesn't do that, we can debate till the cows come home. But that's where the debate ends. If you achieve by going by closing, not testing, but closing above the previous day's high, that's confirmation. And so the day's high right here is 149.96. Okay, that is the high price of today's price action. Well, if I take this down into a 30-minute chart, you're going to notice something. See, understanding the analysis on a daily chart is one thing. Looking how it builds from an intraday perspective is an entirely different thing. The market will tell you where to buy and where to sell if you look for it. The market has clearly told us that 150 is resistance. It told us this multiple times today. In fact, it's screaming at you all day long, 150. In fact, if I go out to a 1-minute chart, you're going to see how 150 played out. Look at the price action all up here between 149.75 and 150. Every time today, and this is just today, every time today it tested in that 149.75 to 150, it came right back down. Every single time. So the question I have for you guys is this. And again, think about what our good old friend Jesse Livermore said about confirmation. We do not move without it. All the trading that was done today, it doesn't matter until what occurs for us. If it goes above 150, nothing matters. And so the first thing we're going to do is we're going to put an order above 150. Okay. Now, as you start learning a little bit more of the intricacies of technical analysis and swing trading in general, you'll start to learn a little bit about ATRs and indicators and using ATRs as a form to simplify your approach to entry and making sure your entries are consistent against different stock prices. We're not there yet. We're here to learn the art of swing trading from a high level perspective, trends, patterns, support, and resistance. So when it comes to that 150, we're going to get in above 150 based on confirmation. I'm going to use 10% of the ATR. So 10% of the ATR above 150, and the ATR is $3. So 10% of $3, and an ATR just stands for average true range. It gives us a statistical measurement of movement for the stock. It ensures that the rule we're applying on the individual stock matches the volatility of the individual stock, and not some random 10 cents above resistance, because that's random, doesn't make sense, and certainly doesn't make sense on a stock like Google or Tesla into comparison to General Electric. And so you want to use ATRs because that will customize the entry rule and the stop loss rule to fit the actual personality of the individual component you're trading. So I'm going to use 10% of the ATR above 150. That puts our entry at 150.30. So if we go above 150.30 tomorrow, and yes, I would bracket that in to make sure that we're protecting against gaps. I just have to say that out there, but you get the point right here. We're getting in above that 150.30. We're going to bracket that in by another 10% of the ATR to 150.60. So tomorrow, and again, let me kind of right click. Let's go to buy custom. You see that where it says OCO bracket? That allows me to place a nice little buy stop limit where I put my stop price at the 150.30. And we're gonna bracket that order in at 150.60. Now, what that means, guys, is what you just saw me do is protect my entry. That's what you saw me do. I put an order to buy this stock at 150.30 in case we go to 150.30 tomorrow. But if the stock gaps up to 156 tomorrow, it throws off my entire analysis. It throws off everything that I'm looking at on CarMax, from a support build to a reward to risk ratio to the probability. It literally changes the pattern. It literally changes the pattern. I need to guard against that, which means I'm going to bracket that in. So the stock has to go to 150.30, but has to routinely just open and trade between 150.30 and 150.60 for us to trigger into there. Once again, I'm just protecting against gaps. If we're trading during the actual trading day, we don't necessarily have to worry about that. Now, the stop loss, there's a lot of different ways you can put a stop loss in the marketplace, but in general, a stop loss is an order that you put into the market to protect against you being wrong in the market. Now, once again, when it comes to Marty the elephant, Marty's sitting on the tramp, right? The trampoline. The trampoline represents support, is what it represents. Well, guys, I don't want to get stopped out if my good friend Marty, who's just out there jumping on a trampoline, goes out there and just jumps on a trampoline. I don't want to get stopped out if Marty does what he's supposed to do. I don't want to get stopped out if CarMax does what it's supposed to do. I need to make sure to put a stop loss underneath support. I only want to get out of the trade if the trade is proven wrong, and the trade's not proven wrong unless support is violated. If support is violated, i.e. Marty, my big old elephant, violates support, for example, if he not only hits support, but then ultimately breaks the trampoline, then I want to get out. Until that occurrence occurs, we want to stay in the trade. And so when it comes to identifying where that support level is, understand it as a zone, but what you want to do is you want to put a number to it. And so if you'll look at where support is building here, you'll see it really build. Again, you're coming down, 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 down. You see that support start to build right there. Well, if you look at it from an intraday perspective, you see that support build. You see that support build. You see that support build. Literally over the last 4 trading days, every time it got into 145, what occurred? Right back up outside of one cash open. 145 has been proven, very similar to 150 in the market, has been proven over the last 4 trading days as an area where the traders are willing to take advantage of it. 150 has been the area traders are willing to sell it at. Well, all of that changes if 150 is violated and we get into the trade, which means I also want to get a stop loss underneath 145. We're going to put that stop loss at 145.70. And again, I'm just going to use 10% of the HR to make it consistent with my entry order. Now, the last thing I need to do as a swing trader, and this is where the fun becomes. This is where the fun really starts happening as you start to learn how to trade from a technical perspective, is the art of targeting, projecting out. One of the simplest, and again, think about what a good friend Jesse Livermore said. One of the first things, there's nothing new in the market. Speculation is as old as the hills. It repeats itself over and over and over again. One of my mentors taught me a concept many years ago called potential average yield. It is a really powerful targeting technique. And when you're looking at potential average yield, what I really want to understand is the personality of the stock in the wave count. So there's wave 1, there's wave 2. So I'm looking at it from where support built historically to where resistance set in before we saw the corrective retracements. So I'm looking at this from 122, it goes all the way up to 144. And so we got a 22-point movement in this first wave. The second wave from support to resistance goes from 135 to 155. I don't care about the wick. Goes from 145 to 155, which is a 20-point movement. First price movement goes 22, second price movement goes 20. Pretty consistent. I like that. I like the consistency of technical analysis. It gives traders a lot of confidence that our triggers, that our stop losses, that everything we're doing will be consistent as well. And so I'm looking at a potential average move of about $21. Well, from support, $21 from 145 plus the 21 in average yield, you're talking about somewhere a target in the 166 range. So the question I have for you guys is this. How many of you, and again, this is an individual choice that individual traders have to answer before they pull the trigger on absolutely anything, because you absolutely have to accept the risk before you accept the return. The only question I have for you guys is this. How many of you are willing to risk $5 to make $16 if everything I've taught tonight plays out on CarMax. And for you new traders out there that don't understand the world of the options market, let me show you what that looks like in the options market very, very, very quickly. So once again, 166 was our target. 150, what was our entry? It's 150.30, right? And our stop loss was 144.70. How many of you guys are willing to risk $244 for $1,000 if we're right on the projection of the analysis? And how many of you, based on what you have learned here tonight, can see an opportunity for yourself in the future? That's what financial education can do for you, ladies and gentlemen. It can help you understand how to navigate the markets. It can help you understand how to project the markets. It can help you understand where to place stop losses, where to put targets. But what it can't do is get you the confidence to take action. That's all up to you. Ladies and gentlemen, welcome to Marty the Elephant. I really do hope you guys had a great time here tonight. I said I was going to go about 60 to 90 minutes. Anybody knows me knows that it was 90 and not 60. So I went 90 minutes from an educational perspective here tonight. I really do hope you guys enjoyed it. Thanksgiving is coming upon us very, very quickly. And I can't tell you how thankful I am for the tackle trading community, for the Trading Justice listeners. This community is truly the best. And I say this a few times, but I'll say it here tonight. I truly do love this community. And I can't wait to work with you guys in the future. I really do hope you enjoyed here tonight. And for those of you who are new to the markets, welcome to Tackle Trading. You found the right spot. Ask anybody in our community. We're here every day. We help each other out. I see it in Discord all the time, people in our community helping each other out. And it's such a beautiful, beautiful, beautiful thing to behold, to see people truly care about one another, care about their journey. And being a part of that is just a beautiful, beautiful, beautiful thing. Jesse Livermore, the last quote I'll give you, and then we'll talk about the specials we're running from an educational perspective over the next month or so. Jesse Livermore said this, and guys, I do believe this goes to the heart of most successful people in the markets. Their number one reliance is education and knowledge. The number one thing they value is education and knowledge. They know that knowledge is the new currency. They can do whatever they want. One of my favorite quotes from Buffett is, they can do whatever they want, meaning they, the proverbial they, politicians, central bankers, the overlords to a certain extent. They can do whatever they want. They can make the dollar worth far less. Are they today? Are the overlords, however you defining them, making our currency worth less, both in terms of depreciation against the asset? Now, how many of you guys are enjoying the inflationary scale over the last year or so? But guys, that ain't going to stop. That's not going to change. Inflation is here, and there's a lot of the current inflation that's going to be lasting. It's absolutely going to be lasting. They can make inflation worse. The currency can get worse. Markets can go crazy. But Buffett said this: if you have knowledge, you have a wonderful asset. Jesse Livermore said it is literally true that millions come easier to the trader after he knows how to trade than hundreds did in the days of his ignorance. You don't know what you don't know, guys. Don't try to nickel and dime the markets. They will take you for everything. Do it the right way. Become a part of a community. Learn how to trade. Embrace education. And whether it's tackle trading or somebody else, guys, that's not my point. I want people who navigate the markets to navigate them the right way, to understand what they're looking at when they log into the brokerage account, to make sure that they're taking action when they should take action. And whether that's tackle or somebody else out there, fantastic. I just know what we do at Tackle Trading. That's all I know. I know what we do for our community. And in our community, guys, Tim talked about it earlier. We have podcasts, we have reports, we have shows, we have courses, we have blogs. We got so much content you are never, ever, ever going to be able to maintain. And I don't. I don't read all our content. We put it out there all the time, all the time. Blogs, podcasts, videos, because we know our community. Some prefer blogs, some prefer podcasts, some love the courses, but everybody loves tackle because that is the community. We are there for each other. And when it comes to understanding tackle trading, I do want to take a moment to introduce us to new members of our community, because we have a lot of people that just know us through YouTube, that don't know tackle trading through what we do in our community. Well, tackle trading and how you found us on YouTube is kind of stage one. We're going on a date, right? We're going on a date. We just asked each other out. We're getting to know each other, right? You get to know, you start to understand. We put out the Trading Justice podcast and the huddle. You come to YouTube and you understand the halftime report and Trade Masters and all the other stuff we do on YouTube. You enjoy some wonderful guides. Guys, if you have not had a chance to take the 7-step guide to trading, I did that a couple years ago. It's a 2-hour free course we give to everybody. Literally, you want the 7-step guide to trading, you're new to tackle trading, you want to test it out, you want to see the quality of the free content we give, go check out the 7-step guide to trading. Go check out the option Greek guide. Those are 2 freemium products we give to absolutely anybody, and I'd put those 2 products up there against any paid product in the market. That's the quality of tackle trading. And if you like the quality of the free stuff we give, just wait till you see what we do in the step system, cash flow condors, bear market survival guide, and coaching. That's the beautiful thing. Whether you're here with us in YouTube, we're going to treat you guys amazing. We're just glad you're here. We got Blogs Trade Center. Stage 2, that's all about the pro membership, guys. That's the Learn, Trade, Connect. That's learning the courses that we provide to our pro members. The Technical Analysis 101, Options 101, Futures 101, Forex 101, System Development 101, our pro member blogs like Option Theory and Tales of a Technician, scouting reports like the Stock and the Options Guide, tools for traders. You connect with other traders, both the coaches and our community, through mastermind groups and our newly minted Discord channels that we provide to our tackle. And then the premium, guys, is for those of you that want to do something a little bit more from an educational perspective, not just the community or the trading aspect of tackle trading, but really understanding systems, the premium systems, bear market survival guide, cash flow condors, the tackle 25, the step system as well, understanding trading labs, the Coach Mark, Coach Emily, Coach Tyler, they all put on trading labs that are unique to themselves, to their way of going about investing and trading. And they communicate every day in Discord. They meet every single week to discuss what is occurring in those labs. And then obviously we also have a one-on-one coaching program to where you can work with somebody at Tackle Trading, one of the coaches of Tackle Trading, to truly build something for you, to take everything we do at Tackle and truly build something unique for yourself. Step 1 is becoming a pro member of Tackle Trading. Guys, during the holiday season, Christmas and Thanksgiving, we do this every single year. We run discounts on all of our products, our pro membership. We got an annual discounted rate of $8.97 for throughout the end of the year. Definitely check that out. Trading Labs, Cash Flow Vikings, Dynasty Investors, Team Phoenix out there. I know we got, what do you guys say? Skull? Team Vikings? Right? Team Vikings, all they do is sit there and scold each other. It's funny. Right. I love it. It's so awesome. We got to get Coach M to get like a little model like Skull. I don't know what it would be. Cash Flow Queen. I don't know. We'll figure something out. Premium Systems, guys. Bear Market Survival Guide teaches you not only to protect your 401k in times of economic crisis and bear markets, but also how to make money in bear markets. Who here wants to learn how to make money when markets go down? Because they don't go down as much as they go up. There's no doubt about that. But wow. When they go down with some heat. They go down strong. Go look at Zoom. Zoom went up like a rocket, came down when it got blasted. These things play out over time. Learn how to make money in bear markets. Cash flow condors, man, beautiful system. Coach Emily trades it. Tyler created it. Tim trades it. It's such a beautiful system to sell options, cash flow against the Russell 2000. Then obviously the step system is a system I did. There's masterminds for each system, but or system, I should say. But lastly, guys, talk to our community about joining the coaching program. Coach Tim kind of handles the mastermind for that coaching program. And you guys, I know there's a lot we do at Tackle Trading. That's why for me, if you know you want to become a pro member, hit us up at Team at Tackle, go to the storefront. You can get access to all of those products at the storefront. We'll onboard you when once that is done. But if you want to talk to one of our coaches to see what is right for you guys, you can do so by going to tackletrading.com/schedule/consult or hyphen consultation. That will bring you to a free 30-minute consultation. And guys, at Tackle Trading, you're not going to talk to a salesperson. I can tell you that right now. The person you're going to talk to when you schedule your consultation, you're going to talk to Coach Tim. You're going to talk to one of our architects. You're going to talk to Coach Emily, the queen herself. You're going to talk to the individual coaches who you will work with. They will put you in a position that is best for you. And whether that's just putting you on freemium or putting you into the coaching program, we pride ourselves in putting you in the best position to succeed long term. And so, guys, if you know this is something you want to do, if you're new to tackle trading, you can come to the storefront over there at tackletrading.com, and you can walk through the storefront to see all of our discounts and all of our different products. If you want to schedule a consultation to talk with Coach Tim or Coach Emily to really determine what is appropriate for you, make sure you can go and schedule the consultation right there. Pick a time. We schedule about 30 minutes for those, but sometimes they go longer. Sometimes they go longer. Again, we're not going to cut you short. This is for you. And with that said, Coach Tim, I had a lot of fun tonight. It was fantastic. You know me, bro. I absolutely love teaching the art of swing trading and really introducing some of these introductory type techniques to new traders. Once again, check us out at Tackle Trading. But if you need some social proof, guys, very simple. You can ask anybody in our pro member community. I'm sure they're in the YouTube channel. I've been kind of focusing on the presentation, but a couple of the testimonies we have received, and guys, we get a lot of them, but some of them, and they're all amazing. I love you guys so much. But I love these three. Angelo says, these guys are the best. They really care about their students. And that means so much to me, Angelo. And they are dedicated to promoting financial education and economic freedom to people everywhere. That is so true. Number two, coming from Rita. Rita, you're the best. Love you. The resources and coaches are excellent and help traders of all levels of experience to succeed. Guys, this is not about where you're at today, whether you're new or experienced. It's about where you want to get in the future and putting you on the best path to get there. And then Bill says Tackle Trading is a great community. Lots of information to help on the path of active trading. Guys, Tackle Trading at the heart of it is a community. It is a community of coaches and traders that have come together to navigate the financial markets and get the help where the help is needed. And with that said, Tim, I am officially done with the presentation. You guys are the best.
Well, first of all, how do you feel, brother? You got to be exhausted after 2 hours of education. And I got to tell you, before you answer that, I got to tell you, that was incredible, Matt. You did a great job. It was impactful in many levels. I've been a veteran of the markets for, what is it now, 16 years. And I just thoroughly enjoyed that. I really did. Even as an educator myself, I love the way that you teach. I've even embraced Marty. Marty's now my second best friend. He's your best friend. So I can't claim him as my best friend, but I love Marty. He's awesome.
Biased. Marty's biased. Marty the Elephant, I guess one thing as an educator that I've found is taking the art of trading can be very complicated, and it can be extremely scary and overwhelming to new traders. What I have found as an educator, though, is putting it into simple terms, funny analogies, creative analogies, just simply have a tendency to make the concepts understand a little bit more. And that's all Marty represents. Marty represents technical analysis. Marty represents pattern recognition. Marty represents support and resistance. Marty represents momentum. Whereas somebody new might see Marty and be like, oh, there's an elephant jumping on a trampoline. What can I learn from that? Somebody, to me, the answer is everything.
Mhm. I agree with that because there was a line you used earlier. Guys, all we're really trading is this elephant here. When you think about different companies as they go from pivot to pivot, as they go from confirmation point to up to a resistance point, you really are trading the nature of the price action. And you said something that also grabbed my attention today. No,
Yeah.
it's not just as simple as big red candle and big green candle. Sometimes it's nice to kind of reduce it down to that, but there is complexity in the markets. That's where the step system course comes in, the
Yeah.
mastermind groups, and actually putting the time in to work your skill set, right?
No, it's not as simple as big green candle and big red candle, but it can be.
Mm-hmm.
It
Yeah.
can be. And I do think the complicated nature comes in as we try to understand why things work the way they do. And that's why I
Mm-hmm.
think if you just focus on this is an elephant jumping on a trampoline, let's go make money.
Yeah. Yeah, we've been 2 hours here. I'm not going to hold you any longer. You have to be exhausted. I think everybody out there,
I'm
Team
ready to go. Are you
Tackle.
kidding me? I was like, I got 5 more case studies. I felt like
You've given us enough, brother. I know you could go 4 hours. I know you could, but you've given us a lot here tonight to kind of chew
can I
on.
just
And
say challenge accepted?
no, I knew you would. I know if I threw it down, you'd be like, all right, let's roll.
Let's
Let's
go.
rock and roll here.
Did Tim say I was tired? Let's go.
I will say this in the chat, guys, a couple things. I love the energy here today, the positivity. That's one of the first things at Tackle Trading that we always believe in is community and conversation and really supporting and helping each other. If you guys have interest in what we're doing here at Tackle Trading, there's several things I would direct you to do right now, just like Matt just walked through. Number one is sign up for a consultation to talk to me or Emily. I loved what you said there, Matt, because yeah, it's not some sales guy. It is two traders, it's the coaches at Tackle Trading. We'll help build an educational plan for you. We'll evaluate whether one-on-one coaching is a good fit for you or not. It's a wonderful program and I want qualified people in that program, but we'll have that conversation during the consult. Number two, guys, if you already know that you want to enroll in one of the premium systems, enroll in the annual pro, Matt, we've got those on a discount. And I think a lot of our Team Tackle, they see the value, they know the value, they could go out and do it. Yeah.
Yeah, we do it every year. We do it every year for our community. Obviously, we want a discount over the holidays like many companies do. And we know financial education is a priority coming into every year. And so we feel like right now, if right now is not the best time, then when is it? I guess is what I would say. So if you've been on the fence about learning how to do this, I think it's time to get off the fence, and this is a perfect opportunity to do it.
I agree. So if you're out there, Team Tackle, one thing I want to do before we wrap up is everybody give Matt a big thank you, big awesome job, something in the chat. Let's show him our support. No question about it. Matt, fantastic job tonight. I know you're going to hate it if I make it about you, but you did do a great job.
I am going to do that.
You did do a fantastic job and a wonderful job. And by the way, our YouTube channel here, if you're looking for daily content, whenever the markets are live, we go live 12:30 Eastern. Do not forget before you leave this channel to smash that subscribe button and click the bell so you can be alerted whenever we do go live. And like you said earlier, Matt, I think on a holiday week, everybody out there, just have a wonderful Thanksgiving holiday. Spend some time thinking about your goals towards the end of the year. Spend some time with family, friends, community, those things that are really valuable. And from all of us at Tackle Trading, happy Thanksgiving to everybody here, in our community. I know that we all really think about you guys every day. And this is what we love, and this is what we live. So I appreciate you guys being here. Matt, any final thoughts from you, as the speaker?
Honestly, yeah, I kind of am talked out, losing my voice a little bit, but no, just truly happy Thanksgiving. Have an absolute safe weekend. Those of you who are traveling, make sure to do that as safely as you can. And more than anything, in a world that's difficult over the last couple of years, at Thanksgiving, let's just all try to be as positive as we can and really enjoy family, except the one. There's always the one. There's always the one. But just let's just try to enjoy what's really important in life, and that's each other.
I 100% agree with that. And I got to tell you, Matt, as I'm heading into the holiday myself, I just want to show gratitude and love to the people that matter to me. And the community here at Tackle Trading is a big part of that. There's no question about that. I would not be who I am today if I didn't have great educators, teachers, coaches, mentors that helped me along the way, that helped me get through my struggles and my challenges and the moments where I felt down or whatever, and they lifted me up. And, I think we all need to remember that, we have teams for a reason, so you don't have to go alone. We have communities for a reason, so you don't have to go alone. And whether you know it or not, if you're brand new to this community, you've found a home here. And you just got to dig in. You got to put your butt in the seat. You got to put the time in and the commitment in to become good at this. And we'll be there to match you. There's no doubt about it. Schedule that chat with us one-on-one. I'd love to talk to you guys. Until then, though, have a wonderful rest of your evening. Have a wonderful rest of your week. I will drop the link in the chat one more time, dropped it a couple times. It will also be in the description of every video just below, and you can find it right on tackletrading.com. Our official email is team@tackletrading.com. If you ever need anything, just reach out to us. We'd be happy to help you.
100%. And oh man, it's going to be a long time before I see a lot of people in the community. I will be on YouTube tomorrow morning for the halftime reports, where we break down a lot of the bulk of economic activity that is coming into the market this week. So looking forward to hanging out tomorrow.
Absolutely. All right, guys, have a wonderful night. We'll talk to you guys soon. We'll see you tomorrow in the halftime show, and I'll see you in those bookings one-on-one. Visit the store page of Tackle Trading and check out those discounts. Till then, guys, we'll talk to you later.
Later, Team Tackle.